Welcome to Wall Street Training's module on the overview of the financial markets. In this module, we will quickly go through the specific industry jargon and go through exactly what is the sell side, the buy side, what is exactly investment banking, asset management, sales and trading, as well as hedge funds and alternatives. Let us now turn our attention to the structured products. Structured products lately, especially with the surge in hedge funds, has become extremely popular lately. What exactly is a structured product? Hey, a structured product simply is a product that's structured. What does that mean? I'll give you an example, a very quick example, what we call a PPN, Principal Protected Note. What if on the one hand, I give you one option? You want to invest, you have the ability to invest your net worth in a 10-year treasury bond that returns 4%. On the other hand, you have the opportunity to invest in the S&P 500, which let's say on average will return you 15%. But here, you're only allowed to invest in option A, 10-year treasury at 4%, or 15% S&P returns. Now, you can only choose one of the two. You cannot invest in 50-50. The question is, which will you choose? Of course, the answer to this partially relies on portfolio management and asset allocation. Depending on where you are in your lifespan, you might say, well, if I'm, let's say, older and in retirement, I probably want to have the security and stability of my principal. So the principal is more important. I want the risk-free 10-year treasury at 4%. On the other hand, if you're younger, you might say, well, I have the opportunity and time for it to grow. But now, in that case, you were given a black and white option. What if I give you the opportunity to invest in the following type of instrument? You can put all your money into this structured product that allows you to do the following. After 10 years, I will take all your money now, and after 10 years, I will return to you the higher of the following. I will return to you, if the S&P 500 was a positive return in that 10-year time period, I will give you whatever the S&P returned. So if your $100 now turn into $200 of the S&P due to the appreciation of the stock market, I will give you your full $200. However, if the 10-year time period, the S&P 500 returned negative, in other words, if you invested your $100 in the S&P and 10 years later it became $90, I will return to you the full $100 of principal that you had invested with me. Which option would you now choose? Again, you're unlimited on the upside in the sense that you will get whatever the S&P 500 returns. The downside is limited to exactly the amount of capital you put in there. Of course, I'll take a few percentage points as my fee, but forgetting that for a second. Think about that. You have the opportunity to invest in the S&P 500. If it goes negative in that time span, you get your all your money, initial principal back. That sounds like a pretty good deal to me. Some of you devil's advocates out there will say, well, you know what? If I put in $100 and I only got $100 back in 10 years, well, that means I lost out on the time value. And that's true. But remember, the scenario here was, what if the S&P 500 was negative? If the S&P 500 was negative, then you would have only gotten $90 back. You wouldn't even have the opportunity to get the full 100. So this structure is what we would call a structured product. You try to structure it such that no matter what happens, there's going to be a win-win situation. Of course, the counterparty who's structuring the structured product is not going to take an unlimited amount of risk in the event that the S&P 500 does skyrocket. So they will actually figure out different ways to hedge their risk, primarily through derivatives, options, and futures, as well as what we call CPI, Consumer Protection Inflation. And so when you look at it from that perspective, what they might do is, as the S&P 500 continues to decline, so therefore they have to return your $100 back, what they would do is start selling some of the S&P 500 stocks, the options and futures they have on the S&P 500, and then start buying, let's say, zero coupon treasuries that will get you back to the full $100. So this mechanism is all part of the structured product. Moving on to asset-backed securities. Asset-backed securities are simply securities that are backed by specific asset or specific collateral. For instance, mortgage-backed securities, which is primarily a bunch of mortgages pooled together, packaged together to sell to investors. Usually you have a series of underlying individual securities that then gets pooled into a mechanism so as to diversify the risk, because you do not want to hold that one individual's mortgage in case they default. What you want to do is have an entire diversified pool of mortgages. Then this pooling mechanism will then go ahead and distribute either on a pro rata or on different tranches, as well as different priority, into individual investors. So you're not investing in one individual security, you're investing in a pool that has a tremendous amount of securities, again, so you diversify your risk. Other types of asset-backed securities might include credit card receivable cards. These are pools of credit card receivables, as well as cars, certificates of automobile receivables, again, pools of car loans. And of course, Liar's Poker, the book that wrote about the inception and the beginning of the mortgage-backed security, highly recommended there.